If you have money sitting in your bank account right now, there's a very real chance you're losing money every single day. And the worst part? You can't even see it happening. It doesn't show up as a charge. It doesn't send you a notification. But silently, in the background, your money is shrinking. Now I know that sounds dramatic, but stay with me for a second, because what I'm about to show you might completely change the way you think about saving money forever. Think about this. Have you noticed how everything feels more expensive lately? Gas, groceries, rent, even a simple meal costs way more than it did just a couple of years ago. That's not just in your head. As of 2026, inflation in America continues to hover around levels that slowly erode your purchasing power year after year. So even if your bank balance looks the same, what that money can actually buy is getting less and less. But before we start, here's a quick note. Hello, my name is Marsh, and I am not a financial advisor. This video is purely for educational purpose only. Always consult the qualified professionals before doing any major financial decisions. Now, most people still believe that keeping money in the bank is the safest thing they can do. Safe from what? Theft? Maybe. But not from reality. Not from inflation. And definitely not from the system that quietly benefits when your money just sits there doing nothing. Now here's the question you should be asking yourself. If the bank isn't really helping your money grow, then what it is? And more importantly, what are the people doing differently who are actually staying ahead of inflation instead of falling behind it? Because trust me, there is a difference. And once you see it, you can't unsee it. Let's make this real for a second. Imagine you worked hard all year and saved $5,000 in your bank account. You feel responsible. You feel secure. You think, at least I'm doing the right thing. But here's what no one tells you. If inflation is around 3% in 2026, which is a realistic average in America right now, that same $5,000 will only have the buying power of about $4,850 after 1 year. You didn't spend anything, but somehow, you still lost value. Now pause for a second. How is that even fair? You did everything right, and still ended up behind. This is where most people get confused, so let me break it down in the simplest way possible. Your bank might give you, let's say, 0.5% interest on a basic savings account, sometimes even less. That means your $5,000 earns about $25 in a year. Sounds okay at first, right? But inflation just took away around $150 in value. So you gained $25, but lost $150. That's a net loss of $125, and you didn't even realize it. This is the part that should honestly frustrate you a little bit. Because banks aren't exactly hiding this, but they're definitely not going out of their way to make it obvious either. Why would they? Think about it. When your money sits in the bank, they're using it. They lend it out. They invest it. They make money from it. And what do you get in return? Almost nothing. Now, I'm not saying banks are evil. They serve a purpose. You need them for transactions, bills, and short-term access to cash. But using them as your main place to grow money? That's where things start to fall apart. So here's the real question. If saving money the traditional way is slowly making you poorer, what should you be doing instead? And more importantly, why aren't more people talking about this? Here's the uncomfortable truth most people avoid. You can't save your way to financial security anymore. That idea worked decades ago, when interest rates were higher and the cost of living wasn't rising this fast. But today, it's a completely different game. And if you're still playing by old rules, you're slowly falling behind without even realizing it. Let me ask you something. Have you ever felt like no matter how much you try to save, it just doesn't feel like enough? Like you're doing everything right, but you're not getting ahead? That's not just you. That's the system you're operating in. Because saving money and growing money are two completely different things, and most people were never taught that difference. Saving is about protecting money short term. Growing is about increasing its value over time. And if your money isn't growing, it's shrinking. There's no middle ground anymore. Think of it like this. Imagine you had a block of ice sitting on a table. That ice represents your money. Now imagine inflation is the room temperature. Every day, slowly, that ice starts melting. You don't notice it right away, but over time, it gets smaller and smaller. That's exactly what's happening to your money in the bank. It looks the same on your screen, but in reality, it's losing strength. And here's where it gets even more interesting. The people who understand this don't just save money. They position it. They make sure their money is working, even when they're not. While most people are focused on not losing money, they're focused on not wasting opportunity. Big difference. And once you start seeing money this way, everything changes. You stop asking, "Is my money safe?" and start asking, "Is my money doing anything for me?" Because safety without growth is just slow loss. So now the real shift happens. If keeping your money in the bank isn't enough, where does it actually belong? So now that we've broken the illusion, let's talk about what smart money actually does differently. Because the goal is not to stop using banks completely. That would be unrealistic. The goal is to stop depending on them as your main strategy. Think of your bank account like a parking spot, not a home. You park your money there temporarily, but you don't leave it sitting there forever. Now here's where things start to get interesting. Instead of letting your money sit idle, smart individuals move a portion of it into places where it can actually grow, even if it's slow and steady. And no, this doesn't mean you need to take crazy risks or become a stock market expert overnight. In fact, some of the most effective options are surprisingly simple. For example, short-term government bonds. These are basically loans you give to the American government, and in return, they pay you interest, usually higher than a traditional savings account. As of 2026, many short-term treasury options have been offering yields around 3% to 5%, depending on the duration. That alone already puts you ahead of basic bank interest and much closer to beating inflation. And here's the key point. These are considered some of the safest investments available, because they're backed by the government. Another option is high-yield savings accounts or money market funds, which often offer better rates than traditional banks. Again, not crazy returns, but enough to at least slow down the damage that inflation causes. And then you have index funds, simple investments that track the overall market. Historically, over long periods, they've outpaced inflation by a wide margin. Now before you think, "This sounds complicated," let me stop you right there. It's not about doing everything at once. It's about starting to shift your mindset from storing money to positioning money. Even moving a small portion can make a huge difference over time. Because remember, the real risk today isn't investing wisely, it's doing nothing at all. So now that you know your options, the next question becomes even more important. How do you actually start without messing things up? Alright, so let's make this practical, because knowing all of this means nothing if you don't actually do something with it. And the good news is, you don't need a lot of money, and you definitely don't need to be a financial expert to start. You just need a simple plan. Step 1. Keep some money in your bank, but only what you actually need. This is your short-term safety net. Think of it as your emergency fund, usually 3 to 6 months of basic expenses. This is the money you might need quickly, so yes, this part stays liquid and easily accessible. But anything beyond that? That's where the shift begins. Step 2. Start moving your extra money into better positions. This could be a high-yield savings account, short-term treasury funds, or a basic money market account. These options are still relatively safe, but they at least give your money a chance to keep up with inflation instead of falling behind. And here's a small mindset trick that can help. Don't think of this as investing, if that word scares you. Think of it as protecting your money from losing value. Same action, different perspective. Step 3. Once you get comfortable, consider long-term growth options like index funds. You don't have to go all in. Even starting with a small percentage can make a huge difference over time. And the reason this matters is simple. Inflation doesn't take breaks. It doesn't wait for you to figure things out. Every year you delay, your money loses a little more power. Now here's a quick question for you. Would you rather take a small, controlled step today, or keep losing silently for the next 5 years? Because those are really your two options. And one more thing, don't overcomplicate this. You don't need 10 accounts, 20 strategies, or constant stress. Start simple. Stay consistent. Adjust as you learn. Because at the end of the day, building financial awareness isn't about being perfect, it's about being intentional. And once you take that first step, everything else becomes easier. So let's bring this all together. The goal was never to scare you away from banks. It was to wake you up to how money actually works today. Because the truth is, the rules have changed, but most people are still playing the old game. They think they're being responsible by saving money, when in reality, they're slowly losing without even noticing it. And the difference between people who struggle financially and those who move ahead isn't luck, it's awareness. It's understanding that money needs direction. It needs purpose. It needs movement. Because if you don't tell your money where to go, it will quietly lose value on its own. And here's the part most people don't realize until it's too late. Time is either your biggest advantage or your biggest enemy. The earlier you understand this, the easier everything becomes. But the longer you wait, the harder it gets to catch up. So this isn't about making a huge, life-changing move overnight. It's about making a small, smart decision today. Maybe it's moving a portion of your savings. Maybe it's opening your first investment account. Maybe it's just starting to learn more. Whatever it is, start. Because doing nothing is no longer a safe option. And if there's one thing I want you to remember from this entire video, is this: that your money should be working just as hard as you do. Not sitting still. Not falling behind. Working. Growing. Moving forward. So take a moment after this video and ask yourself one simple question. Is my money actually helping me, or is it just sitting there? And if the answer makes you uncomfortable, that's a good thing. Because that's where change begins. And remember, you don't need to be rich to start being smart with money, but you do need to start. So if you found this video helpful, share it with someone who still thinks saving money in the bank is enough.